Afternoon, everybody. Welcome back to my channel. It is me, the Millennial Investor, 1914. Holla at your boy. Today, we're talking about for retirement. Should you use the strategy of the 4% rule or the dividend investing? So we're going to talk about the 4% rule, what it is versus dividend investing. What is the best strategy for you? Make sure you strap your shoes up, ladies and gentlemen. Make sure you get some candy and popcorn because hope you guys came ready to learn. Let's dive in. When you sit down, there's multiple strategies. There's trading, dividend investing, dividend growth investing. The 3 to 4% rule is basically when you comprise of a portfolio. You've been investing for a lifetime. You've been comprised a portfolio. Quick example, right here. The 4% rule is this. Let's say you start out with a $10,000 investment. You invest $850 per month for 30 years, receive a 15% rate of return. It shows that you're going to have a portfolio worth $5 million. If you decided to say, hey, you don't want to wait the whole 30 years and you wanted it to do 25 years, you will retire with $2.5 million. Then where the 4% rule comes in is that the 4% rule states that out of your pool of your portfolio, you can live off of 4%. They've did studies and they have adjusted that you can bump it to 4.5, but for this illustration, we're just gonna do 4%. And so a $2.5 million dollar portfolio times 0.4 will be $100,000 that a person will be able to live off of just for 30 plus years. If you go a little bit above that, then you kind of stretching it in regards to just the stats. That's the 4% rule. Easy. That's what a lot of people do. When they invest in their 401k, when they invest into outside of their 401k. That's what they tend to do. Uh, Now, versus dividend growth investment. Dividend growth investment is when you buy dividend stocks and you also create a portfolio. And here's a quick example. Here is a dividend growth calculator. When you are doing a dividend growth, you are comprising a portfolio. It could be as low as 5 stocks, as many as 20, 100 stocks. Or you can invest into a dividend ETF like SCHD, as in dog. But the illustration is here is that you're starting out with $10,000. You're going to be contributing roughly $1,000 in your dividend growth portfolio. In your dividend growth portfolio, you're going to have many different stocks. You're going to have Apple. Quick example, just real quick. So, how a dividend growth portfolio will look like will be in my portfolio. Real quick. So, right here, you see how I have uh, instead of just investing just into ETFs just for the 4% rule. You see right here, you have a basket of stocks that I invest to. So basically, like Broadcom, Microsoft, American Express, Booking Holdings for people that like to travel, Costco, TSM, SCHD. What else? You get the you catch my drift. So you have a portfolio of stocks that's growing. That's not only growing dividend wise, but also growing in regards to total return. With all those different stocks that say that the dividend yield of your portfolio is at 2%, you're going to set the parameters that your dividend income is going to grow at a 10% clip per year, give or take, and that the appreciation of your portfolio is going to grow at a 10% clip each year. And this is on the low end. 10% is the market average. It tends to your portfolios can depending on what stocks you have can grow at 15%, 20%, 30%. Depends on what stocks are in your portfolio. What you see right here in the same example when we looked at with the 4% rule, when you just invest in just strictly just for ETFs, VU, VGT, whatever, for 30 years, you saw a greater base, right? A greater so this is floor. You saw a greater ceiling. With that portfolio, you saw it produced 5 million. With the dividend growth portfolio, it's not going to produce as high of a portfolio value as if you've been investing for growth, which sorry, which corresponds with the 4% rule, higher base. But the reason why a lot of people choose the dividend growth route is because of this uh, income, being able to being able to get paid on a monthly, quarterly basis, and you not be able to have to touch the base compared to when you are doing the 4% rule. Yes, you have this big portfolio, but again, that 4%, you're selling off 4% of that portfolio per year to live off of, compared to a dividend growth portfolio. These assets you don't have to touch. These assets are growing as the market grows. These assets are paying you passive income. So right here, a $2.6 million portfolio is paying you $54,000 per year. And then don't let it be if you sell some of the lower yielding assets, and then you put that money into a higher yielding asset like SCHD, maybe realty income, VC properties, uh, BDCs like OBDC, or if you want to really get funky, put it into like JEPI or JEPQ. Have a portfolio of SCHD, JEPI, JEPQ, and then the rest of your stocks to let it grow. So I just wanted to show you guys real quick a little bit of the comparison of when you invest into just dividend stocks, the dividend growth route. The portfolio, as you see right here, it says that after 30 years, you have a portfolio of 3 million, compared to if you just invest in just for growth, VU, VTI, VGT for 30 years, compared to that, using the 4% rule, you have a way higher pot portfolio. But there's cons. Here are the cons. I've already talked about why individuals choose the 4% rule and why people choose a dividend growth portfolio. But the cons is the risk is that for the 4% rule, assets owned shrink each year. So, like I said, you start out with a decent sized portfolio, but you're selling it off at 4%. So your pie or your portfolio is shrinking because you're selling off the assets. That psychological pitfalls, meaning that when you don't have like a regular job and you can bank on that paycheck coming every 2 weeks, when you are the person that's in charge of your portfolio and selling off and live off of, then there's a psychological portion when the market falls, bad news, etc. And then the possible of running out of money. The second big risk is called the sequence of returns risk when you deal with the 4% rule. What is the secret return risk? I actually looked it up for you guys. So the secret of return risk is when it's the risk of a negative market returns occurring later when you want to retire and you taking money from your portfolio. Let's go through a quick example. So the reason why a lot of people like to do dividend growth investing or dividend investing towards the end of their life is this. So imagine a person start out with $1 million, and most people don't. But just say you start out with $1 million, 500,000. You decide to retire at age 65, like an example, as you see. A lot of times when you want to retire, you want to make sure that those years that you plan to retire, that they are in the green and not in the red, meaning that the market goes down. When the market goes down and you take money from your portfolio, that's when you see what the sequence of return risk. See right here, the first year the market goes down minus 9%. But you're also still taking, in this case, this person is taking 65,000 because they need $65,000 per year to live off of. Then, and at age 66, the market return is It's minus 11%, 11.85%. But then you still got to take $65,000 portfolio. So what happens that it's like your portfolio is kind of like double dipping in the negative, meaning that your portfolio is decreasing based upon the market, and then you still have to take money, 65,000 from your portfolio to live off of, compared to if you are dividend growth investing, having a dividend growth portfolio. Guess what? This 2.5, 2.6 million or 1.5 million is paying you dividends regardless. Now, of course, dividends are not free money, and dividends are not guaranteed money. But for the most part, when you are investing to blue chip stocks, for the most part, I would say roughly 85 to 90% chance you can sleep well at night, like with Johnson and Procter and Gamble and uh, Microsoft and those type of stocks. You can sleep well at night because we still have to use those type of companies. We use their products on a day-to-day basis, uh, compared to the dividend growth investing. So that's the negative with the 4% rule. The 4% rule, as you see, the portfolio is a lot. It's a lot larger, but you are at the mercy of the market. If you want to retire at 50, 55, and the first 2 or 3 years the market's in negative, you're screwed. Compared to when you're dividend growth investing, guess what? Whether the market goes up or goes down, you get paid dividends. But everything is not also peach and cream and sunny with dividend growth investing as well. The negatives of dividend growth investing is that a stock heavy portfolio is perceived as riskier overall, which is true. So that's why a lot of times a lot of people invest into ETFs, a basket of stocks, so that if a couple stocks go down, or a couple of stocks decide to not want to pay its dividend, there's other stocks in that ETF to help. ETFs like DGRO, DGRO, SCHD, uh, what is the VIG, Vanguard's appreciation, dividend appreciation ETF. So those ETFs, they're a basket of stocks compared to a risky of just investing a lot of money into one stock. But as dividend growth investors, we live on the wild side. We're wild boys and girls. We like to invest into real stocks, the Microsofts, the Apples, to because again, single stocks is a lot riskier than an ETF. So when the market goes up, your portfolio is going to go up a lot. But then when the market goes down, your portfolio is going to go down a lot as well. So keep that in mind. But also, I just want to let you know as well as that, keep in mind that in the growth, developing your money, making money stage, that as we all in right now, the accumulation phase between when you're 20 years old all the way up to when it's time for you to retire. I must admit the 4% rule with the invest into investments they're going to grow your portfolio. It's a lot more beneficial than just dividend growth investing. Dividend growth investing is really, I would say, pivotal maybe like in your 40s, as you pivot to your 40s, 50s, and 60s. Uh, Growing your portfolio in total return helps in the beginning. The reason why is that I've been investing for the past 8 years. I started out dividend growth investing. I will still do different dividend growth investing videos. I love dividends, but if I can go back, I would really just start out with just a VU and just would invest in that, and I just would have rolled it out, because the market has produced rate of returns that's been higher than mine, and I see it now. I thought that the market only produced 10%, but that's only the average of all the returns that it does. I've seen VU produce rate of returns of 15%, 17%. Opened my eyes last year. VU produced around 25. It got as close as 28, but then a couple days it was running red, so it went down to 25%. I just would have just really invested to VU and just would have just call it a day. Ask the question: would you rather do dividend investing and 4% rule? I say do both, and the reason why I say do both is every portfolio has is every portfolio has its strategy and direction. For example, why not either or. Why not have both? And that's what I do, where I have a dividend growth portfolio, and then in my Roth IRA, my rollover IRA, and in my 401k, I invest into growth, VTI for growth, to use the 4% rule for my retirement funds, and then my brokerage account, my taxable account, I invest into dividend growth stocks so that I can be able to live off of 25 years from now. So that's why I proposed the question: would you rather do the 4% rule versus dividend growth investing? I talked about the positives, I talked about the negatives, but also my stance is, why not do both? And so make sure you just pay attention to all this as you sit down and look at my videos, and you plan for retirement. Think critically in both. And I say do both, but if you don't have the financial means and you cash strap, I would say focus on the growth first, VTI, and then as you get more money, branch out into more dividend growth investing and more dividend growth stocks. So, like and subscribe to my channel. Peace.